All right, today we're going to tackle a question that's absolutely critical to the health of our entire economy. How in the world do banks manage the massive billion-dollar risks they take on every single day? It might sound super complex, but stick with me because understanding this is actually pretty key. Let's dive right in.
So, let's just start with a number. $1,125,000,000. Just try to picture that. Imagine that's the total value of loans a single bank has on its books. I mean, it is a staggering amount of exposure. One wrong move, one little downturn in the economy, and a number this big could seriously trigger a financial meltdown.
So that's the big question, right? How do banks handle this much risk without just collapsing? Well, the answer lies in this really powerful framework that separates the losses they can predict from the ones that are truly catastrophic. And it all starts with the part they can actually plan for.
First up, we have the predictable part of the equation, something called expected loss. You can think of this as just the normal, everyday cost of doing business if you're in the lending game.
Expected loss is pretty much exactly what it sounds like. It's the average amount of money a bank expects to lose from loans that go bad over, say, a year. They've got tons of historical data, so this isn't a surprise. It's a calculated, manageable risk.
So how do they figure this out? Well, the formula is actually pretty straightforward. It's the loan amount, or exposure, times the probability of default times the loss given default. So for example, if we look at loan 2 here, you take the $150 million exposure, multiply that by the 3% chance it might default, and then by the 25% they'd actually lose if it did, and you land on an expected loss of just over $1 million.
Now, here's the cool part. When you do that simple math for every single loan in that entire billion-dollar portfolio, you get a total expected loss of about $5.3 million. Or, to put it another way, a totally predictable loss rate of just 0.47%. And just like that, that scary, intimidating number from the beginning starts to seem a whole lot less terrifying.
And this number isn't just for show, it's incredibly practical. Banks use it to set aside money into what they call loan loss reserves. That money comes directly out of their earnings for the year. It also helps them price their loans to you and me. For the bank to actually make a profit, the interest and fees they charge have to be more than enough to cover these expected losses.
But what about the risks you can't predict? You know, the black swan events that go way, way beyond the average? Well, that's where we get to the really dangerous stuff. The thing that actually keeps bankers awake at night: unexpected loss.
Yeah, this slide says it all, doesn't it? If expected loss is like a predictable rain shower that you can handle with an umbrella, your reserves, then unexpected loss is a Category 5 hurricane. You can't cover a hurricane with your day-to-day reserves. For that, you need a much, much bigger safety net, the bank's own capital.
We're not talking about just a bad quarter or a tough year. We are talking about that once-in-a-century type of event, a truly catastrophic loss that could completely wipe out a bank's profits and, honestly, threaten its very existence.
And that is why global regulators are so obsessed with it. Big international rules like Basel III are basically designed to force banks to hold enough of their own capital to survive their own worst-case scenario. We're talking a 99.9% confidence level event without taking the entire financial system down with them.
So what causes these huge, unexpected losses? Well, it's often not just one single thing going wrong. It's usually a toxic combination of two very dangerous forces that multiply the risk: concentration and correlation.
First up, we've got concentration risk. This one is the classic, super intuitive mistake of, you guessed it, putting all your eggs in one basket. And that basket could be a single company, a single industry, or even a single country.
I mean, just look at this portfolio. You can see it clear as day. Loan 7, that huge blue slice, makes up a whopping 37% of the entire portfolio. If that one company goes under, it could take down more than a third of the bank's loan book right along with it. That is a massive, concentrated risk.
Now, the second multiplier, and this one's often way more subtle and dangerous, is default correlation. This is like the hidden web that connects all the different loans together. It's the risk that when one basket falls, it causes a whole bunch of other, seemingly separate baskets to fall too.
Think about it this way. A pandemic hits, and the airline industry obviously gets crushed. But it doesn't stop there, right? Hotels, restaurants, tourism, they all tank too. Even though they're technically different industries, their fates are deeply connected or correlated. So instead of a few defaults here and there, the bank suddenly faces this massive cluster of defaults, all hitting at the same time. So what does all this mean in plain English? The crucial point is that correlation makes those extreme, catastrophic, once-in-a-century events, well, much more likely to actually happen. It's the secret ingredient that can turn a bad situation into a full-blown systemic crisis.
Okay, so why should you care about any of this if you're not a banker? Because this whole framework, this entire way of thinking about risk, is the safety net that protects our entire economy, and by extension, the stability of your bank account and your savings.
So to wrap it all up, expected loss is the predictable, everyday cost covered by the bank's profits. Unexpected loss is that catastrophic, worst-case risk, and it has to be covered by the bank's own capital cushion. And always lurking in the background are concentration and correlation, the twin threats that can turn a manageable problem into a financial firestorm.
And all of this leaves us with one final, very big question. If we have these incredibly sophisticated models to measure risk and all these global rules to enforce them, then why do financial crises still seem to happen? What do you think is a missing piece of the equation? Let us know what you think.